Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audio cast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association.
Good afternoon, everyone. Welcome to the MTA Podcast Series. My name is Craig Johnson. I work at Piper Jaffray in their Technical Research Department. Our co-chair, we're one of the co-chairs for the Minnesota MTA Chapter. We also have Tim Braun with us here this afternoon. Tim?
Good afternoon.
And Tim, where do you work?
I work with RBC Wealth Management.
Perfect. And we've got a great presenter that presented to the Minnesota MTA Chapter here today, Louise Yamada. As many of you know, Louise Yamada currently is the Managing Director for Louise Yamada Research Advisors, founded in October 2005. Previously, Louise was the Managing Director for Technical Research for Smith Barney Citigroup. She has been a perennial leader to the institutional investor poll and was also the top-ranked market technician in 2001, 2002, and 2003, and also 2004. We got a really interesting update here from our Minnesota chapter we want to share with you all here today. Louise has got some conclusionary comments to open up with, and then Tim and I have a couple questions for Louise. Louise?
Thank you very much, Craig. I think that one of the most important things to cover at this point in time is interest rates, because back in February of 2010, we did an educational piece called Preparing the Mindset for a New Structural Rising Rate Cycle, particularly at the long end, which is the end we no longer control because so many foreigners own our debt, and the Fed is only in control of the short end. But basically, we have a chart of 200 plus years of interest rate history in our country. And one of the things that we observed many years ago is that interest rate cycles are very long, 22 to 37 years. And reversals from rising rate cycles to falling rate cycles have been very sharp, inverted V affairs. But the reversals from falling rate cycles to rising rate cycles have been very long, slow, saucer-like, multi-year affairs that have lasted from 2 to 14 years. One of the reasons being that there were deflationary pressures at each of those events. If you think about the last rising rate cycle, which began in 1946, that was 14 years after the 1932 bear market low. So we have now been in a declining rate cycle for almost 30 years, and we think that the 2008 collapse to 2.68% on this composite chart was our pivot low, and that we have been in a transitional trading range since 2003 when we suggested such a range under a 5.5% level. We now have a slightly higher low in place and have just put in place the first slightly higher high. So we believe that the trend has reversed and that we are initiating or moving into a new structural trend of rising interest rates. If we look at the, well, you can't look at it, but the 30-year has really been our canary in the mine and has started to give us buy signals, and a move through 4.805% would suggest that the interest rate at the long end could continue toward our 5.5% threshold, and that would affect about a 9-year basing process for the 30-year yield. The 10-year is a little behind it, moves through 4%. It will be in a range that eventually could take it higher toward that same threshold, 5.5, but we suspect the 30-year is going to get there first. The question came up as to whether these were indicative of inflationary pressures. We are of the opinion that the long end is starting to rise because we don't own our debt anymore. China's buying less, Russia's not buying any at all. latest thing that we've read is that the Federal Reserve is one of the largest holders of U.S. Treasuries, and the question has to be asked, to whom will they sell? So I think the long end is probably going to continue to rise.
Hey, Louise, if I could ask a question here, in this kind of
please do.
In this kind of change in the longer-term interest rate, what sectors of the market are you most interested in at this point in time when we're in a rising rate environment like we're now entering?
Well, I think it's more of a question as to which ones you might not want to be in, and utilities is the first one that comes to mind. And as we looked at it, it had a declining relative strength profile. That's one that's most sensitive to interest rates right off the bat. Whether or not financials are going to be helped or hindered by this, their relative strength still looks abysmal as part of their structural decline.
Excellent.
Louise, one of the things that you had brought forth was the concept of a hybrid market. Can you give us an idea of what your view is on how we would manage that going forward? We're used to thinking about things in the context of a geographic location. It sounds like maybe that paradigm is maybe shifting.
Yeah, well, in 2006, we did a piece called Bull Bear Hybrid because there was such a dichotomy in the way certain stocks were behaving. And we rather think that we had, of course, entered a structural bear market in 2000. We think now the pivot low has been seen in the decline in 2009, and that we are in what we call the repair phase, which is on the right-hand side of the pivot low, in which you have cyclical advances and cyclical declines. But the concept of the hybrid market was that given the global development that is taking place today, we have a lot of stocks that are participating in that environment and are perhaps oblivious to the concept of being in a structural bear market, as the overall market may well still be defined, notwithstanding very generous cyclical rallies in between, because we have seen more and more stocks either coming out of major consolidations the way technology names have done, or emerging from major consolidations which now are carrying price through the 2007-2008 peaks even, that suggest they are moving away and into their own structural bull market advances, so to speak. And I think that that is the hybrid aspect, that the overall market may still be in either a structural bear or the repair process of such, or moving into a new bull market, which we haven't defined yet as structural, but certainly is cyclical. And yet you have these stocks that are participating, almost dancing to the tune of their own drummer.
You know, Louise, one question, this is Craig as a follow-up to this. At what point in time would you conclude that we have entered a new structural bull?
That's a very good question, and I guess it would probably be with a sustained move up and out with good volume and good statistics to a new sustainable high, because characteristically, cyclical bull markets within a structural bear market tend to fail to sustainably move out to new highs. They may tickle the old high, they may go beyond it, like it went through 1,000 in the early 70s and then all of a sudden just gave up the ghost. So I would say you would have to sustainably go out to new highs with a powerful advance, the way 1982 did to end the prior bear market, or the 1942 also was a very strong thrust up.
Okay. I want to, Louise, given the time, I want to thank you very much for presenting to the Minnesota MTA chapter here today, and we hope we can have you back again. Thank you again, Louise.